Good morning everyone, this is Amit Prabhari, founder and managing director of CR Forex. In the last week video we were discussing that ideally dollar index should take support at 100 level and it should move higher. And exactly in this week we have seen that dollar index has taken good support at 100 and it has moved toward 102.50. Now what next? If you see the chart, dollar index has broken a critical resistance of 102. If 102 holds for one more week or one more day, we can say that dollar index is moving higher towards 105 level and the probability of it is 90 to 95%. Now what will trigger dollar index to move higher? There are two important reasons for the same. First important reason is that debt ceiling issue will create demand for dollar and dollar should move higher. Second, US economy is performing much better as compared to Europe economy and UK economy, which is going to put pressure on euro and pound. Now let me show you one more interesting chart. If you see the dollar rupee chart, it was trending on a lower zone from last 1.5 months. Finally on Friday it has moved above 82.10 kind of a level. Now technically speaking, if the pair continues to trade above 82.25, then we can say that there is a 90 to 95% probability that the currency is going to move towards 80 to 83 kind of a level in next 10 to 15 trading session. Now let us understand why it will move towards that level. The first negative factor is that dollar index has given a breakout and there is a positive correlation between dollar index and rupee. If dollar index move higher, rupee will generally get weaker. Second negative factor is that there has been a stop or a halt between Russia and India in terms of invoicing in rupee, which is going to increase our trade deficit by $45 to $50 billion in next 1 year. Third important factor is that if you see Asian currencies, Chinese currency has weakened from 6.90 to 6.97. If it continues to move towards 7 or 7.10 level, it is going to keep pressure on rupee. On the positive side, there is only one positive side, that is we have been continuing receiving inflows in equity market from last 1.5-2 months. Considering all of the above factors, fundamentally and technically, we continue to believe that the rupee will take support between 81.80 to 82 kind of a level, and the view remains the same that the pair is going to move towards 80 to 83 kind of a level in next few trading session. Now let us discuss strategy for thin margin exporters like agri exporter or chemical exporters. Last week we suggested thin margin exporters that they should cover 60 to 70% of their exposure between 81.90 to 82.10 kind of a level. For remaining position, we suggested them they should wait for a target of 82.20 to 82.40 kind of a level. Now, for this week, we are suggesting them for the old orders and for the new orders, they should continue to wait with a stop loss of 82.05 and they can target to cover between 82.40 to 82.80 kind of a level. Now let us discuss strategy for thick margin exporters like textile exporter or engineering exporters. We have been suggesting them from last 1.5 months that they should wait for higher levels to cover their exposure, higher levels of 82.60 to 82.80 kind of a level. Now the view remains the same. They should keep a stop loss of 82.05 and wait for high levels of 82.60 to 82.80 to increase their hedge ratio. Now let us discuss strategy for importers. We have been suggesting importers that they should cover their next 45 to 60 days import between 81.80 to 82 kind of a level. Any importers who have missed covering at those levels, ideally they should keep a strict stop loss of 82.30. If that level is broken, then they should immediately go and cover 50% of their import payable which is due for next 30 days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.